All right, session 17, real estate finance. We are making such good progress. So let's continue on and let's start talking about financing real estate purchases. Now, the majority of our economy runs on borrowed money, so very rarely anymore do we seek all cash home buyers buying their permanent residence. Happens a little bit more with investment properties, but typically we have to have a loan to be able to buy the property in our American society. So we have to deal very closely with lenders, and as a real estate agent, there's a fine line between what you need to know and what you don't need to know, but I will tell you that the more you know about the availability of loans and how that system works, the better you're going to be able to help you to navigate your buyers and sellers through the transaction. The golden rule of real estate is do unto others, like we learn in kindergarten. Do unto others as you'd have them do unto you. But the second golden rule of real estate is the people that give us the gold make the rules. So if we have to depend on, oh, I've accomplished my goal, my production crew, I finally made them laugh. Hey, I got a snort too. That's awesome. That's a good way to brighten up a dull chapter. We're just going to keep that in there, guys. But the golden rule of real estate, the people that give us the gold make the rules. If I can't get financing for my buyers, I'm not going to be able to sell as many houses. So again, a lot of the information in this chapter, you're going to have to read through the different types of loans, some of the different qualification factors, but don't think you're going to know everything from reading this material, because remember, it's not our job to get them the loan. It's not our job to get them approved for the loan. That's the lender's responsibility. And every individual mortgage company, every individual lender has their own guidelines, but what you're going to learn about in this section is an overview of some of the different types of loans that could be available to buyer consumers whenever they are looking to finance property. Let's take 1 second for a vocabulary checkpoint. I'm always trying to make sure I'm pointing out to you when common everyday language differs from the way that I want you to remember vocabulary word for real estate and testing purposes. Big one is the word mortgage. First of every month we say I'm going to pay my mortgage, but whenever we pay on our car payments, we don't say I'm paying my car mortgage, right? We say we're paying our car note usually, or just paying my car payment. What's the difference? By definition, a note is a promise to repay a debt. So technically, when you pay that mortgage payment on the first of every month, you're actually paying your note. Because anytime you owe someone money and you make a payment back to them, that is considered a note. Money that you owe somebody, and the note, the document or promissory note, is the documentation proving that you are agreeing to pay somebody back money. Then why do we call it a mortgage? Well, the mortgage is another document we call a security document. You've heard of secured and unsecured debt. Like an unsecured debt would be a credit card. You know, that credit card is based just on my ability to get financing and get a credit limit because of my good credit rating and my payment history. But unsecured means that card payment isn't attached to anything, and every time I buy a shirt on my credit card, I don't have to send them a copy of my shirt and where to come find it. It's unsecured. But mortgage notes, the note itself, the promise to repay the debt, is secured by the property. I can't walk into most lending institutions and just based on my credit report and the smile on my face be able to walk out with a $250,000 loan. They're only going to give me that loan because I'm pledging my home, the real property, as security for that debt. And that's where the mortgage comes in. The mortgage ties your house to that promise to repay a debt, because if you don't pay, you don't stay, and the mortgage company now, or your lender, knows where to come and find your house, and that foreclosure process we talked about in earlier chapters can kick in. So the note itself is the promise to repay a debt. The mortgage ties your property to that note, and that begins the foundation of the things that we need to know about properties being pledged as security for debt, which is the basis of real estate finance. So in this chapter, you're going to learn about lots of different topics. I'll warn you, this is a loaded section, so put your thinking caps on, grab yourself a cup of coffee, because you are going to be learning several different concepts on your own and different types of loans. But there are a couple of things that are a little confusing that I just want to give you some real life examples for that'll help it make sense when you read in the chapters. So one of the big concepts you're going to learn about are the difference between the primary mortgage market and the secondary lending market. I'm sure you've probably heard those things on television, you've heard them on CNN, you've heard them on different news channels, but the primary market or primary lenders and secondary mortgage market and how they interplay in the financing game of real estate. So let's just say that I'm a lender. A lender is someone who loans their own money for the promise of repayment, and typically you're going to make money back on the interest that you charge to give out that loan. Because just like our houses themselves, the money that is loaned is also a commodity. Money is bought and sold for a profit also. Kind of strange concept, but we're going to learn how money is bought and sold for a profit. So if I'm the lender, and let's say I have $100,000 in the bank, and I loan each of you $10,000, I'm going to make 10 loans and loan out all of the money that I have in the bank. Well, now my cash stores are depleted. I can't loan anybody else any money. So how am I going to make up the extra money to have more money to loan? Well, I could take all of those loans that already gave out, and what's a document that would prove that you owe me the money? Your note. I could take all of those notes and I could sell that package of existing loans to somebody else that would give me a certain amount of cash back, and now you owe them the payment for that note instead of it coming back to me. Well, that's the difference between the primary, the original lender, primary mortgage market, and the secondary mortgage market. Primary market is that first person that gives you the money, but then involved in the back scene is the secondary mortgage market, which buys up pools of existing loans, and now they handle the servicing and also get the long-term benefit of those monthly payments over the course of the 30 years or whatever the term of the loan is. You're going to learn about the different players in the mortgage market, Fannie Mae being the largest of which. There are several. You've heard Fannie Mae, Freddie Mac, Ginnie Mae. You're going to learn the details and how those are all set up and initiated and how they interplay. But one other point that I want to focus on before I let you dive into finance is interest points charged on a loan. And you've heard about those for sure, because of course we're not going to loan you money if we're not charging you an interest rate. Right? Right now interest rates are fairly low, but whenever they start rising, sometimes people want to pay interest up front to buy down your overall interest rate. So the interest rates themselves are a yield to the lender, a money made by the lender, which is what a yield is. But let's take a look at points, because again, it's going to be a little bit confusing when you get into your chapters. So let's say that the interest rate today is 5%. The interest rate's 5%, and that would be my simple interest on my loan. So first of all, you've got your regular interest rate, which is the interest charged on the balance of your loan. You're also going to learn about other things, closing costs, discount points, other things that are accumulated and charged by the banks. All of those things added to your interest rate give you what you've heard about, the APR, annual percentage rate. That is not only your simple interest rate, that is the simple interest plus all of the other fees charged by the bank lumped into one sum. The reason for that is because you're going to learn in this chapter, we had to regulate things a little bit and make them a little bit more self-explanatory for buyers so that you can compare apples to apples. Because one mortgage lender may give you a 4% rate, but if they're charging higher amounts of closing financing costs, you think you're getting a deal and maybe you're really not. Where another bank could charge you the 5% interest rate and no additional fees, and your overall cost of that financing would actually be cheaper. So the APR is like a balancing gauge that no matter what all the background fees are, APR is a reason or a way to compare apples to apples, because it accumulates all the fees charged and puts it into $1 amount. So hopefully that'll help that make sense. But let's go to the board for a second and look at discount points on a loan. So whenever you get into this section, you're going to hear that a discount point is 1% of the loan. But you're also going to hear that a discount point reduces your interest rate by 1/8%. Well, how is it 1% and 1/8%? I can't tell you how many times with a concept like this in all my years of teaching pre-license, somebody comes to classroom 30 minutes early and says, Marlene, I've stared at this concept for 45 minutes. I don't get it. I don't understand. Can you please explain it to me? I've tried to pick out some of those to help you guys as you have to navigate your way through this online course, and this is definitely one of them. So how is a point 1%, but it's also 1/8%? Well, this is how. Let's imagine that this point is a pizza. Good pizzas have 8 slices. Good pizza cutters do a better job than I do, but imagine with me. So I said that a point is going to be 1%. Well, whenever I buy a discount point, I'm going to pay 1% of my loan amount on my purchase price of the property. So 1% of my loan amount is what that point is going to cost me. So if I'm financing $100,000 on a house, 1% or 1 point would be $1,000. With me so far? So I would pay 1% of the loan amount to get 1 discount point. But if that's what I'm paying, what am I getting back? Whenever I pay 1% of my loan amount, what they're going to give me in return is a 1/8% reduction in my interest rate. So I'll pay 1% of the loan amount on the property for them to give me a 1/8% reduction in my overall interest rate. So now that 5% interest rate isn't 5% anymore. I've bought it down 1/8%. So what would I have to do if I didn't want a 5% interest rate? I want a 4% interest rate. I'd have to buy 8 points, which means I would pay 8% of my loan amount to reduce it 1/8 for every percent, right? And then I would bring my interest rate down 1 whole percent throughout the life of the loan. So it's going to cost me 1% of the loan amount to, in return, get back a 1/8% reduction in my overall interest throughout the term of that loan. And sometimes when the rates go up, that can make a difference. But hope that helps clear up that topic a little bit when you get to it. And also hope that you enjoy learning about real estate, finance, and the different methods available. And again, don't get too scared, because remember, you're going to be holding hands with a lender whenever you get started in the business. We need a broad overview of what types of loans are available to different types of buyers, but ultimately we don't do the loan qualifications. We usually don't pull credit. We don't look really deeply into their personal finances. That's up to the lender. All you need to be aware of are the different types of concepts and loans available, so that whenever a buyer tells you what they're looking for, you can guide them in the right direction and be aware of what's available to help your purchasers buy property with borrowed money. So I hope you enjoy this chapter.